Welcome to the Business of Soil Health. I'm your host, Patrick Smith, and the founder of Soil Upside. I am really excited to have Maggie Monast with us today. She is the Senior Director of Climate Smart Agriculture at the Environmental Defense Fund. Welcome, Maggie.
Thanks, Patrick. Happy to be here.
Yeah, I'm so excited to have you here. I have really admired your work from afar for a long time. You've written a ton of different articles and research that the EDF has published about the economics of soil health across the entire value chain. So I'm really happy to have you.
Thank you.
So let's start with talking about farmers and farm economics. Your work has touched really across the value chain, from farmers to buyers, large companies, to lenders, to insurers, and obviously policy work too. So we'll try to touch on as many of those as we can. But the fundamental piece here is growers. So can you tell us about the work that you've done there and kind of some of the economics, the economic impacts that you've seen of climate smart practices?
Yeah, and we're really fortunate at EDF to have a group of farmers who've advised us, some of them for over a decade. They're some of our most important strategic advisors. We really want to have farmers at the center of what we do. And now maybe 7 or 8 years ago, they came to us and they said, we'd really like to better understand the impact of the conservation practices that we're doing on our budgets. And that honestly surprised me, because this group of farmers, they're business savvy and they're very committed conservationists. They've been doing this stuff for a long time. So if they still had questions about how some of these practices were affecting their bottom line, that told me that there was a much bigger issue there. That was what got us started digging in with farm accountants and then land grant economists and farmers themselves, really trying to tease apart how are different climate smart or conservation practices, how do they affect the farm budget? And how is that different from conventional practices? And how does that maybe require different financial solutions for farmers to be able to use them effectively?
It sort of goes to the heart of on-farm economics, which is, is it yield or is it ROI? And what's the cost of production? What's the profit per acre? All of those really fundamentally basic questions, but are actually really difficult for many producers to answer.
Yes.
And so what did you find as you dug into the research?
It's a very typical economics answer, but we found a lot of it depends kinds of situations. So we dug into some of the typical row crop practices that you'll hear about a lot, nitrogen efficiency, cover crops, different forms of tillage. That was where we started. We found that tillage, there's a pretty strong economic argument for that. With reduced costs from fuel savings, less trips in the field and save time, and less expensive equipment. Nitrogen, there's a strong argument for, reduced cost, but the real issue there is risk. And so farmers are still reluctant to reduce nitrogen because it only takes a very small amount of yield drag to make it not worth it to cut the nitrogen. And so that is something that we're still grappling with. A practice change where it makes sense economically if things go well. But as we know, things often don't go well in agriculture. And then cover crops is the one that's kind of the real nut to crack that a lot of people have been working on. You have to be honest, it's just an added cost. On the face of it, right? It's more seed time, passes, whatever you use to terminate it. And so the dependencies with other practices are really where farmers can actually make it work economically. So, for example, if you're adopting no-till and cover crops together, that can help. If you are reducing nitrogen and herbicide passes, once you adopt those cover crops, that can help. And then also just being, kind of learning from fellow farmers about how to be really cost effective with the cover crop itself. So obviously the different seed mixes cost different amounts, and farmers have to be really strategic about if it's worth it for them to have, a more expensive seed mix or not. And so all of those factors together are what determines, whether it will make economic sense in the short term. Then, of course, over the long term, you're building the health of the soil. That should bring you more yield resilience. We are starting to see economic evidence of that, but that's another one that can be challenging to prove, even though many farmers experience that.
On the studies themselves, you guys put together a collection, I think in partnership with, was it University of Minnesota, maybe?
Mm-hmm. Yep.
And there's a collection of studies on the economics of conservation ag and climate smart practices. What's the name of that resource?
Well, you can find all of these resources on our Ag Finance Resources Hub. But what we learned was that farmers and also their lenders really rely on these land grant farm financial centers and databases. And the one at the University of Minnesota is called FinBin, and it's kind of the largest and probably most well-known farm financial database. And so we've worked really close with those folks and the Center for Farm Financial Management in Minnesota to integrate cover crops into that database. So that database that helps farmers compare their own finances to their peers will now integrate cover crop information as well. We also did one with Minnesota and some of the other, like Wisconsin in that area, where we just compiled the different studies that were out there. So that would include our work and also the work of others, because we were trying to make it available to everybody in that region. So we also just have like a soil health hub that we contributed to, helping bring together all these different analyses.
And what's that one called?
I think it's like the Soil Health Nexus.
That's exactly what it is. That's the one I was trying to remember. Yeah. If anybody's interested in digging into a broad range of studies on these, that's a great collection of them. I think that, one of the real challenges, and I've read most of those, I think there's 65 or so in that collection. I think
Impressive.
I have another 20 or so that I've pulled together. And 99% of them are focused on practices as opposed to biogeochemical attributes of the soil and that economic relationship. I'm curious if you can talk about that a little bit, because that really is fundamentally what we're talking about is how do you rebuild soil health and how does that affect on-farm economics versus how do you implement, a specific species of cover crop?
It's a great question. And I think there is some interest in looking at this specifically by soil type and other soil qualities. I think that there's a focus on the practice because that's the thing that the farmer can actually do. And then, of course, you can measure some of those different variables of soil health along the way, and that can give you the sign that you are improving. But I really think it tends to focus on the actions that farmers can take. And similarly, these are practices are typically the things that farmers can sign up for, NRCS programs for. I do think we have to be kind of careful of getting really locked into just practice thinking, because then we lose some of the connectivity. And like I said before, the connections between practices is where you actually save money. So I hear your point on thinking about this from other analytical angles.
I've talked to some producers that have soil organic matter as sort of top of mind and practices as a way to build soil organic matter. I heard a soil scientist earlier this week talk about how aggregate stability is actually the most important metric that she looks at. If she could just choose one, that would be the one metric that she would look at. Talk to others where it's fungal to bacterial ratio, for example. But it does seem like in addition to practices, having one or two core kind of soil health metrics that producers can use as a target and that soil scientists can use as an indicator is really important.
Yeah, I think in general, this theme of trying to connect up the economic performance of the farm with, like, we'll call it the environmental performance of the farm is really important. And practices are kind of just a in-between proxy for that. But obviously we all know you can do a practice well or you can do it poorly. And farms are at very different starting points in terms of their soils and other natural resources. So it's a point well taken that ideally we would have all of those dots linked up.
Yeah, one agronomist that I know relatively well has talked about how, cover crops will fail, just like, cash crops will fail.
Right.
But when a cash crop fails, a grower doesn't necessarily, I'm never growing that crop again.
Right.
Whereas oftentimes if a cover crop fails the first year or two, it really is discouraging, which is understandable. And at the same time, allowing for refinement of, is it species mix? Is it, planting time? Is it, all of the different variables is really important when you're talking about those specific practices.
Expectations matter, financial planning and planning for a transition matters. And also in those moments, I think farmers having peers that they can consult with on this kind of thing is what really matters. Because whenever you're trying something new, right, if you feel like you're alone, that makes it really hard. If you have others that have shared your experience and that you can bounce ideas off of and troubleshoot with, that makes it seem much more doable. And I might say that the farmers who are out there basically being the trailblazers on regenerative probably have a lot of attributes that make them unique. And also we need to find a way to move beyond them to the mass of producers. So I really just don't believe we can make every single farmer have the same mentality as these leaders in the regenerative ag movement. So honestly, we need to learn from those leaders to break things down and make it something that everybody can do. And that, I think, is where the rub is. So collaboration is super important, but not everybody's going to embrace that mindset. Just like I know a lot of farmers who are deep scientists of the soil, very fundamentally into it. And not everybody is going to be like that. So a big question that I ask myself is how do we reach them too?
Many of the producers I know that are at the forefront here are artists. And it seems like the ag industry generally is, and this is true of every industry actually, is mechanistic.
Yes.
And looking for inputs, specific outputs. And obviously we're at a conflict now where our mechanistic ag system is having all these deleterious effects that are very hard for us to continue production environments in. And to your point, it sounds like you think that there needs to be a translation layer between kind of the experimentation that's happening right now and creating some sort of replicable system that can be used to advance climate smart ag.
Yeah, we've tried to fit these ecological processes inside, a mechanistic box, and we've seen some of the failures of that. I hope that maybe we can come to a place where it's embracing the best of both worlds, where that those mechanistic impulses are adapted more to the needs of the ecological system, so that we can, continue to have, an abundant, safe food supply, which is a huge achievement of this food system, but do it in a way where we don't have the the environmental impacts of the current system, the other social impacts and challenges, the challenges with rural communities. We need to find a way to weave these things back together.
Do you have examples of where you've seen that happen, where the ecologically focused farming is systematized?
Oh, that's a really good question. I think we are seeing lots of little examples of that. Like farmer clusters working together to, like you said, collaborate, share examples, and figure out what they need. For example, I was on one of our farmer advisors farms last September in Idaho. They have this incredible farming operation, and it's at scale. It's 20,000 acres. They grow a diverse mix of crops. They've been pioneers in no-till. They're experimenting with cover crops and trying to get their chemical use down as much as possible. They also have cattle and timber operations integrated. and they are collaborating with some of their neighbors, trying to figure out like, okay, what are some of the other pieces of the markets and also like the input infrastructure that's missing here that we might need to be more successful on a broader scale. So, I see farmers leading the way on that. We have a very entrenched system, and so I think it's hard for those farmer clusters to kind of break in with that bigger system.
Yeah, and it also seems some of the experimentation is, we have these defined conservation practices, the set of NRCS conservation practices, but there's also so many different emerging practices that are possible and can have really profound effects, whether that's biochar or specific amendments or, biologicals or manure, separate, different kind of manure management or composting. Obviously, some of those are NRCS conservation practices, but some of them aren't. And so it still seems like we're in this era of experimentation and sort of trying to figure out what works at scale for producers and can be applied in their specific context.
Yes, and I think we'll always be in that place, right? We'll never have the full answer of exactly what works everywhere. It's always going to be evolving, especially as we layer climate change on top of that and the stresses that come with that. So we really have to think kind of region by region. What's the predominant system? What are the climate stressors and other impacts? How is this going to have to change? And how do farmers get there? And how they get there financially, that's what my team has really focused on.
Yeah, so let's dig into the financial piece of this a little bit. I mean, we could talk about the practice piece for a lot longer, I'm sure, even though neither one of us are growers. Can you dig more into the economics, particularly as farmers start to layer practices on top of each other, and kind of is there accelerating economic benefit of implementing these practices?
We think so. I think farmer experience is far ahead of what economists have been able to document. And so really economists are trying to keep up and catch up with farmers. And of course, access to data is always a challenge when we're trying to do that. And do economists have access to the right kind of data that will let them actually show this? But we're starting to see some of that come out in the evidence. For example, there was a wide-scale study after the really wet summer and flooding of 2019. Some researchers with University of Illinois were able to get access to the crop insurance data set associated with that and married it up with, again, practice data, but able to see farmers who were doing no-till and cover crops. And they saw a substantial difference. Farmers who were doing those practices had less crop insurance losses, and this was really focused on prevent plant. So farmers were able to actually get back into their fields and plant, and they didn't have to incur that crop insurance payment.
That's the Meridian and Agree study?
Yep, with Meridian and Agree. That's right.
Yeah, I'll link to that.
That's right. So I really think it's this case of following the farmers and trying to prove them right with data and figuring out, where we can do that in ways that then influence how other actors in the system operate. What's the evidence that's going to be needed by policymakers, by ag finance institutions, by insurers, by supply chain companies to shift the way that they do business.
Yeah, and that seems to be crucial on the economics side, but also on the soil science side, where we have these vanguard producers that are layering on practices and experimenting with various things and really responding to the specifics of their contexts and showing some remarkable results in terms of soil building and carbon sequestration and water infiltration rates and all of these different indicators that we look at, not to mention increased profitability. So in your grower advisory group, would you say that there are kind of vanguard growers in that group that are figuring it out kind of at a more accelerated pace?
Yeah, certainly. They would probably be too humble to call themselves that, but I would call them that. There's some farmers doing really incredible things on their farms. and also being really collaborative and sharing with their neighbors. And so, to your previous point, I think that's really important. And what I do think is happening that's great is these farmers who are really showing a new path in agriculture are being recognized for that. The internet now allows them to stand out with their expertise and share their expertise in a way that they never could before. And it's cool. And I think more and more people are recognizing it as that.
Before we move on to talking about lenders, to sort of wrap up the conversation on the grower side, even though we could spend the whole hour just talking about producers, can you talk about the tensions between short-term and long-term economic outcomes? Because so many producers that I talk to have such pressure short-term. And the long-term, there's this case to be made for implementing climate smart and regen practices around greater profitability. A recent BCG study that showed 70 to 100% greater profitability. But it also showed that in the short term, there is a significant pressure economically, which many growers just can't sustain because, if you lose one crop or one field or two fields, like it can put the entire operation at risk. So can you talk about that tension a little bit?
Yeah, absolutely. It's a thin margin business. We all know that. And any of these investments in regenerative ag also have to be taken in the context of the overall investments that the farm business needs to grow. And so, it just boggles my mind the different things that farmers have in their brains at any moment in time, like trade with Japan and, bird flu and who knows what else. And then also, can I make these practices pencil out? And we have to be honest, there have been some really rosy profitability studies, but it doesn't always turn out that way. A lot of times this is about some cost savings and some yield resilience, which overall, make the business, more profitable, more sustainable over the long run. But we're not talking about like massive yield increases. And so the farmer really has to kind of be in touch with their budget, do the work to make sure they actually get those cost savings, because those usually require, subsequent changes in what they do, continuing to adjust to optimize. And also some luck. And so I do think that there's kind of an unfair focus on the farmers being able to just figure this out on their own. The current system is stacked against them in terms of doing that. The ones who've been able to do it are fabulous. But for the majority of farmers, when you're swimming upstream and the current's going against you, it can be exhausting. And maybe that's not the thing that you want to spend your time doing. Maybe you want to be at your kid's baseball game, for a personal example. And so I really, and this is a good transition. I think I always say regenerative agriculture can be profitable. That doesn't mean it is going to be. It depends on a lot of things. And that's why we have to get the financial incentives and support right to make sure that farmers can make that transition successfully and maintain it over the long term.
Yeah, it's super important. And it is a really good segue to talk about the broader sort of systems forces at work. Let's start by talking about lenders. Because debt is such a core feature of the ag economics landscape, both on the land acquisition mortgage side and also on the operating side. And now we have alt lenders, there's FSA guarantees that on the traditional lending side, direct FSA loan, like the landscape is relatively complicated. But can you talk generally about the lending side and their familiarity with climate smart practices and how that's fitting into underwriting at the moment?
Yeah. And first, I'll go back to that first economic analysis that we did with some of our farmer advisors, because one of those farmer advisors, after we did the study, introduced me to his lender. And we shared the study with his lender. And honestly, I had never really thought about ag lenders before this. And he said, "This is great. I love this data. I wish there was more of it." Now in retrospect, I'm like, obviously, farmers, close financial partners also care about this information. But at the time, agricultural finance institutions were really not part of this conversation about sustainability, climate, etc. I think they very much saw themselves as kind of their role as just capital provision. They don't have anything to do with these trends. But I realized that they were going to be really important in this broader systems change. And so I started trying to make friends with lenders. And initially they were like, "No, thank you. I would prefer not to talk to you, environmentalist." But I really tried to approach it with the spirit of learning from them, trying to understand their business, trying to understand the pressures that they face, how they want to serve their customers. And, before too long, we began to find common ground. If you want to know somebody who cares more about farm profitability than maximizing yields, that's a lender. If you want to know somebody who cares about the long-term value of land assets, also a lender. If you want to meet somebody who cares about the risk of their overall lending portfolio, also a lender. But I think just they had not quite connected the dots between, for example, portfolio risk and climate risk, or, land value and soil health, or profitability and, nitrogen efficiency. And part of that is because they just don't get the data at that level of granularity. They don't have access to that. They get high level financial figures from farmers. And so many of them would tell me, yes, the farmers who are doing these kinds of practices tend to be our more successful financially farmers, but they had no way of kind of disentangling that, or, to your point, integrating that into any of their business operations. So that's what we've really been trying to do, is collaborate with lenders to figure out how they can better understand the business case for farmers and themselves for regenerative ag, and then how they can integrate that into the way that they do business.
We were talking about Vanguard growers a minute ago, and it sounds like what you're describing is Vanguard bankers. And inside the Vanguard banker group, there's loan officers, and then there's executives.
Yes.
And of course, there's boards and all the other sort of governance structures. It seems like from my travels and talking to growers and a few lenders that by and large, we're still talking the vast majority of underwriting is very traditional ratio based. Like, let's look about debt to asset ratios. Let's look at, just standard economic ratios, rather than these more sort of forward thinking and I think what we could call like risk reduction activities. And so I'm curious, the extent that you're describing these lenders that are actually open to or thinking about things like portfolio risk and climate risk, how much of the industry does that actually represent?
I mean, it's hard for me to overestimate how early days it is for the ag finance sector to really get their hands dirty on these topics. We did, a couple of years ago, we did the first global survey of agricultural finance institutions with Deloitte on climate risks and opportunities. And we found that 87% of those ag finance institutions believe that climate change represents a material risk to their business. Yet just 24% had begun to integrate it into their business decision-making in any significant way. Like, let alone underwriting, just like any kind of decision-making. So there's just this huge gap between, lenders really starting to recognize this is a risk, And then figuring out how do we operationalize that in a way that makes sense for our business, makes sense for our farmer customers, is kind of tenable over the long term. And so that's a lot of the work that we're doing. In the US, the vast majority of ag lending is done by kind of two groups. One is the farm credit system of cooperatives, and one is ag banks. Within that ag bank group, it includes some of like the big kind of brand name banks like Rabobank and Wells Fargo and BMO, but the vast majority of lending within that banking group is like smaller community lenders. So it really is a pretty broad market segment, if you want to call it that, and a lot of different players and a lot of people to reach. For example, some of the leading farm credit associations, they've just hired their first chief sustainability officers in the last 2 years. They've just published their first sustainability reports. So they're really only now wrapping their arms around what this might actually look like and how they can serve their customers with this kind of work.
You guys recently did a study on loan officers, or a survey on loan officers. Can you talk a little bit more about that, what you found?
Yeah, I think it boils down to, and this is what I've seen in my conversations with loan officers too, kind of they're with us intuitively. Like, yes, I see that these practices are good, but they're very unsure about their role as it relates. So 86% of those loan officers wanted better economic information on the financial impacts of those practices. And they also have, legitimate limitations in the way that they can act on this. Lenders are not allowed to tell farmers what to do. And that's a good thing. That's something we should protect. But I think that because of that tends to kind of stifle thinking about what they can do. What they can do is be a source of education, opportunities, programs, etc. Like, as long as they're not telling a farmer to do something, they can still offer lots of different ways for farmers to engage. And so we're trying to shift more lenders over into thinking about what they can do instead of what they can't do.
It's really fascinating because, yes, I understand and respect that loan officers hesitate to prescribe specific things to growers, and that's a very good thing, as you mentioned. And at the same time, when I talk to those vanguard growers, they are very frustrated most of the time with their local lenders because they're not getting the kind of support that they want for the on-farm activities that they want to do. So there is this, on the one side, lenders don't want, and loan officers in particular, don't want to dictate activities. And on the other side, they're not open necessarily to some of the experimental stuff that some of these vanguard growers are doing. So that's on the one hand. And then on the other hand, I've talked to lenders, particularly one where there's an agronomist who sits on the lending committee. And he was like, I don't understand what they're saying because we don't take practices into account at all in our underwriting. So I'm curious if you can comment on that kind of tension between those two experience sets.
I know they're kind of talking past each other, and also at the same time we have to recognize there's a huge array of lenders in this country, and experiences will vary, right? So I do think that some of the more, I've certainly heard also from some of the kind of more cutting edge farmers that they have challenges in speaking with their lenders about some of these practices, especially ones that don't have a really clear return on investment.
It seems like there's the potential opportunities for alternative lenders who can think differently about risk and who can model some of these activities in a very different way. And so my entrepreneur hat has often sort of pinged on what if there was a banker, like I'm not a banker, but what if there was somebody who understood ag banking in detail and understood regen and conservation ag practices in detail and the economics associated with that, to stand up an alternative lender that's specifically focused on these vanguard growers that are trying to create really positive ecosystem outcomes. I'm curious if you think there's a market opportunity there.
I would say kind of yes and no. So we've certainly seen some examples of this, like, Mad Capital is a great example of, an organization that's financing regenerative organic and really trying to meet the needs, I think, of those kind of particularly, those vanguard producers, as you described it. We've also seen, for example, we worked with Farmers Business Network, their finance group, to develop a farm operating loan where farmers got 0.5 percentage point interest rate rebate if they met standards that EDF set for nitrogen efficiency and soil health. For that product, FBN initially launched a $25 million fund. It was quickly oversubscribed by farmers and became FBN's fastest selling product ever. So there are, for sure, farmers out there, there's demand for this kind of modified lending that supports them in achieving these goals and also recognizes the value, the risk reduction that they are producing. At the same time, however, established banks and farm credits do have several advantages. One, especially in the case of the farm credit system, they have access to really low cost capital. And that's hard to beat. And two, a lot of times these are long relationships. This is like the farmer's relationship with their banker can be a lifelong relationship. It can be, oh, my dad banked with this loan officer and now I bank with this loan officer. And so I do think that some of that disruption is probably a good thing to show that there is demand from farmers. But ultimately, we need to get the big players to change how they do business if we're going to create change at scale.
Yeah, the FSA guarantees in particular, undergirding that lower cost of capital for conventional lenders is a massive market force here. And for example, with Mad Ag, my understanding is that because they have to offer, they're not FSA guaranteed, but they have to offer competitive interest rates. And so it requires concessionary capital to actually fund the loan pool that they have to loan out of. So on a kind of economic opportunity side, it seems like somebody needs to acquire a local community bank and then use the infrastructure that they have in place to be able to really, be structured specifically around regen and conservation ag practices.
Yeah, or maybe the local community bank will figure out how to do that themselves. I would say don't underestimate the folks who are already in these communities. But in addition
point.
to the FSA guarantees, there's also farm credit. That system, they sell bonds in order to have their capital that flows through that system. Those bonds are really highly rated because there's like this implicit government backing, even though it's not government money. And so that is a major source of their very low cost of capital. And then also, insurance comes into this as well. And so insurance is often required by lenders, or else you have to have a lot of collateral to offer instead. And so the kind of the constraints of the federal crop insurance system also create some boundaries around what farmers can do and can't do that then, kind of bleeds into their lending relationship as well.
Yeah, that's a great segue into talking about the insurance piece here. My understanding is that this is actually one of the reasons why lenders and loan officers have had a challenge underwriting operating loans, in particular for producers that are doing some of this experimental work, because historically it's fallen outside of the bounds of the definition of good agricultural practices that the RMA has used. And so if a lender is requiring insurance and the RMA doesn't accept the practice that the grower is implementing on farm, then that obviously creates real tension and can eliminate the grower from the lending pool. My understanding, though, is that as of a year ago, maybe a little bit longer, the NRCS conservation practices have been included in RMA's definition of good agricultural practices. So can you talk a little bit about that?
Yeah, so that's my understanding too. I think about crop insurance and the barriers in a variety of ways. One is Like, is it actively preventing farmers from doing good things? And I think because of some of the changes that the Risk Management Agency has made over the last several years and in the last few Farm Bill runs, many of those obstacles have been reduced or removed. So that's a good thing. I'm not saying that it includes like all of the cutting edge practices, like we know that's not true, but for most of the, the core conservation practices, follow-up research has shown that crop insurance is not an impediment to farmers adopting those. But there's this like much bigger question out there, which is the relationship between crop insurance and climate change and adaptation. Because crop insurance, right, that's just a risk transfer that just makes you whole financially, or not whole, but helps you out financially if you experience a loss. But that doesn't have anything to do with farmers actually taking action to reduce risks. And, crop insurance is backward looking in its model. What I would love to see is some more kind of forward thinking about what are these climate risks that are accelerating and how can crop insurance work symbiotically, either through the crop insurance program itself or with other programs to help farmers take adaptation, actions to actually reduce that underlying risk. Because if we see this across all kinds of insurance also, like this is not just a crop insurance thing. It's the relationship between the insurance and the actual risk reduction. And if the actual risk reduction is not happening, insurance becomes, untenable to fund over time. And so we really need to figure out how those can better fit together to support these farmers who are actually reducing that underlying risk.
So I'm curious how you think about reshaping the risk management structure and some of the work that EDF might be doing there.
Yeah, this one is tricky because, unlike supply chain lenders, crop insurers really can't do anything unless the Risk Management Agency allows it. They are very hemmed in by policy. And so any change in crop insurance almost has to go through a policy lens. We do a lot of corporate engagement where we try to, get companies to be leaders and do different things. But on crop insurance, it's really more like learning from the crop insurers about where there are disconnects between, actual risk management and crop insurance, figuring out the kind of research we can do to ultimately support policy change. And at the same time, there are these areas, like you said, where crop insurance, there's just a disconnect with where kind of the climate and agricultural production system is going in a region.
I have to call out my friends Aria and Harley at Landcorp because they're really focused on policy through a risk lens. And they're creating this risk model that ultimately I think they want to use this very detailed analytical risk model as a way to quantitatively prove to the RMA and policymakers that some practices actually do reduce risk in a material way.
Yeah.
I'm curious if you can comment on the work that they're doing, and are you partnering with them on that? Are there other folks that you know of that are working on quantifying risk reduction through some of these practice implementations?
Yeah, I'm not directly involved in Landcorp's work, but I'm familiar with it. And I think that is the direction that a lot of, economists and other organizations are going, is trying to build the data set that shows the explicit link between soil health and conservation practices with reduced risk, and then to try to build that into the way that crop insurance works and is priced. We also have to recognize at the same time that both with lending and crop insurance, these are really, really core aspects to farm businesses surviving. And so understandably, farmers and farmer organizations are very careful about, any changes that could be made to crop insurance through the policy process. And so this is a tricky needle to thread. How do we build the data that shows the need for change fast with, lots of limitations on data access? How do we build the political consensus that change is needed and that it will actually benefit farmers in the long run? This is one of the more challenging issues, but it's going to be, I think, essential as we navigate the continued threat of climate change.
So really risk feels like a through line of all of the pieces here that we're touching on. On-farm risk, both economic and environmental. We're talking about lending risk, portfolio risk, but also risk of individual loan recipients and their default. We're talking about insurance and obviously risk to the entire system. And I'm curious, it seems like some of the, again, coming back to the Vanguard growers, they're kind of choosing to manage all of this risk on their own. They're opting out of, in particular, crop insurance, but in many cases, they're building up enough of an economic cushion so that they don't have to take operating loans either. And so I'm curious if you can comment on, this goes back to what you said earlier on, we really need the system to be able to support all producers. But what do you see what does that say to you when you see these producers that are at the Vanguard kind of opting out of these risk management structures and doing it on their own?
Well, the first thing that it says to me is they probably own a big chunk of their land if they're able to do that.
Yep.
And that's not the reality for many farmers. And I don't want to discount at all the work that they do to be able to get to that point, because I think it's amazing. But we also have to recognize that is not going to be the reality for lots of farmers. So there is this continued push-pull of learning from the leaders and also recognizing that not everybody's a leader. Like, that's the definition of leadership. It's not everybody. And figuring out what is applicable to other farmers. There are also, groups of farmers that have been really systematically excluded from some of these different financial levers that we're talking about. We do work with the Intertribal Ag Council, with Occupton, which is a Native American community development financial institution, and with the Federation of Southern Cooperatives that represents Black farmers in the South and their cooperatives. And they have done some of the most innovative work on financing farming operations because they've had to. And, it's a bad thing that they've had to, but also there's a lot we can learn from them as well. And so that's some of the work that I'm most excited about, is getting together some of these different players. We have a new Ag Finance Sustainability Coalition that we announced not too long ago that includes Occupton, that includes Farm Credit, that includes Farmer Mac, the national secondary market for ag loans. And that includes Native Agriculture Financial Services, which is a new financial institution that's kind of bringing together some of the strengths of the farm credit system with Native agriculture. There's some very cool cross-pollination that's happening. And it all goes back to this theme of, how can we learn from each other? How can we learn from the innovators and support them in doing more of what they're doing? And how can we bring along the big guys and help them change the way that they're doing business as well, so that hopefully, all farmers will have access to this kind of support.
Before we move on and talk about the company side, which is really sort of the third major piece, the markets, the third major piece of the system that farmers operate in, was there anything else on lenders or insurance that you wanted to touch on?
Yeah, just, I mentioned with, some of the ag lenders, they're just getting started, but I'm still really excited about where they're headed. Two of the things that we're collaborating with them are, one, on climate risk assessment. So helping them really understand the climate risks to their portfolios, so that they can better scope out, where are farmers at risk and how can we help them mitigate those risks. And the other is coming up with, different ways of financing these different regenerative practices where that, is based on the underlying economics and needs of the producers. So things like transition loans is what we're trying to develop. And that, I think we're going to see a lot more of that in the next like 1 or 2 years.
So let's talk about the markets piece, because, all of the systems surrounding growers, where they're getting capital from, how they're getting their risk managed, and then where they're selling products to. The companies have an interest, at least theoretically they should have an interest in the climate impact and the climate risk of their supply chains. So can you talk a little bit about your work with companies and kind of where you see the economic motivations of some of the forward-thinking buyers?
Yeah, and it's actually the supply chain work, honestly, is what has given me the confidence to try to take on the ag finance sector. This was probably 10 or so years ago. EDF was collaborating with Walmart, which was setting different kinds of environmental targets and was setting a nitrogen target and asking their suppliers to contribute. And so we were there, alongside them trying to figure that out in very early days. And at the time, I remember being in conversations with people, not at Walmart, but kind of like other experts in the field who are like, oh, no, like almost patting us on the head. Like, that's so adorable. Like, you can't do sustainability in commodity supply chains. It's a black box. It's impossible, et cetera, et cetera. Like, we were so naive to believe that this was ever going to be a thing. And it's a thing now, over half of the top 100 food and beverage companies have net zero targets. And so while I can't say that, everything has been figured out and they've all totally nailed it, in the last 10 years, the movement and the investment is undeniable. And so seeing that evolution, seeing how we went from nothing to tons of engagement, lots of people working on this, trying to figure out the best way to get these supply chain incentives to farmers, is really what made me feel like maybe we could make this happen in ag finance as well.
And how do you see that playing out practically? How are the incentives flowing through to growers? I've talked to growers that are not corn and soy growers who are interested in participating in some of these too. So how widely distributed are these incentives?
Right now, I would say it is quite spotty. And so if growers are confused, I don't blame them. There are some kind of like governing rules and bodies for these companies to try to, make claims and account for things. But in terms of how it's actually delivered to farmers, it looks very different for lots of different companies. Many of them are working with their suppliers. Others of them are going around their suppliers and going straight to producers and funding, technical service providers that do work directly with producers. Some of them are paying farmers for practices. Some of them are paying for outcomes. Some are just paying for that supporting like TA and other infrastructure. It is all across the board. And the new USDA Partnerships for Climate Smart Commodities initiative kind of like just puts all of that on steroids, because now there's this huge influx of, $3 billion federal dollars coming into this landscape. Many RCPP awards also are, aligned with supply chain ambitions. And so you're magnifying the supply chain efforts with federal dollars as well. So I think we're in this kind of like messy, market discovery, kind of like figuring out what this is going to be. Just basically like explosion of plant 1,000 seeds and like see what works. But there are certainly, some that I would point to as kind of doing some particularly interesting stuff. PepsiCo in particular, we're collaborating with them on a climate smart commodities initiative with Field to Market that's focused on innovative finance. They're helping to fund some of these new risk protection things called warranties that kind of go alongside crop insurance, or not a replacement for crop insurance, but can help farmers navigate the risk of adopting a new practice. They're also, supporting some of the really great technical assistance providers like Practical Farmers of Iowa. So I've seen some interesting, work from them where they're really trying to both get incentives to growers directly and testing new models of what's actually going to work. And that's the kind of thing that I find really exciting.
To what extent do you find these efforts being integrated into the standard procurement processes, or are they happening outside of that, like through sustainability budgets? And you mentioned Partnership for Climate Smart Commodities grants. Essentially, to what degree are they operating in pilot mode still versus like being implemented into standard corporate practice to operate at scale?
I think it really started in sustainability land and is kind of slowly migrating into more procurement land. And right now, I think we're kind of in between, where a lot of them are like learning to work together, which is really good, learning to understand each other and figuring out, what makes sense. But there's some kind of obvious, I don't know if it's conflicts, but maybe differences in motivations between, a sustainability team and a procurement team, right? A sustainability team wants to invest in a place and in a group of farmers and help them change their practices and improve over time. A procurement team wants to buy, corn or whatever the ingredient is. And when you throw climate change into the mix, what's the easiest thing for a procurement team to do, right? Just like source from somewhere else if you can't get it from this place. And so figuring out how you kind of get the corporate support for long-term investment in a given location, even with the change that we're seeing, is going to be really interesting to see how that develops.
This makes me think that it's really the CFO's office that needs to be involved in these conversations. To what degree are you engaging with companies at that level?
There's quite a bit of, executive engagement in this. I would say it's still more on the CSO, but I think the CSO is increasingly, working alongside the CFO. And so kind of in the same way, they're learning to speak each other's language. Now, of course, this varies dramatically company to company. Some are, really sincerely trying to figure this out. Some are sitting back and watching to see what happens and if they're going to have to do anything. So, again, we try to work alongside the leaders and support them in being successful, and then find a way to get, the others to follow suit.
It seems like this has to be viewed as an investment, like financially motivated investment, as opposed to something quote unquote good to do for the world. And I think that there are, can you talk to the motivations that companies have for setting SBTI, the Science Based Targets Initiative targets, and hitting the climate targets that they have?
I actually think companies are kind of in a tough spot on that because, yes, the environmental and economic rationales have to be aligned. But I also don't think it's easy for companies to say, like, this is just about business. Think about other areas that are important to them, like human rights. It's like you're either respecting human rights or you're not. And those kinds, it's you can't bring, business rationale into that conversation. And so I hear that, and I'm certainly trying to figure out how this can make sense for business, but also like business has to change. And so some of the things that, maybe we once held sacred will change as well.
I guess I'm curious to what extent you all are involved in, outside of the social license and, some of the more qualitative goodwill, some of the more qualitative kind of business benefits of investing in climate mitigation activities. To what extent are you all helping companies identify some of the tangible and quantifiable benefits of investment in these activities?
It's a great question. And I would almost take it in a slightly different direction, which is that I think companies have, the ones that are out there actually trying on this in the past 10 years, they've gotten out there, they've created programs, they've seen kind of what their investments can do. They've seen what they can get with, $15 an acre versus 5 versus 20 with the farmers in their supply chain. And they're like, this is not going to do it. This is not enough. No matter how big we are, it's insufficient for systems change. And so some of these leading supply chain companies have now become great allies in trying to engage on crop insurance, on ag finance, on government programs, because they see the need for all of these different pieces to fall into place. So it's almost a different take on economic value, but they're trying to figure out how do we bring in other sources of economic value for the farmer to support them in this overall shift. And that's been one of the biggest trends that I've seen over the past few years, is that these companies are shifting from thinking just about their own sustainability programs to thinking about systems change.
It's really amazing. Yeah, definitely allies in the broader thinking, those folks that are, again, forward thinking and can see the connections between the elements here. Maggie, I really have to thank you. You have such a holistic view on this space across farmers, lenders, insurers, companies, such a wealth of experience and wisdom and hard lessons learned. Did you have anything that you wanted to leave us with?
Yeah, I just think that we are in a moment for regenerative ag or climate smart ag in terms of the investment, both public and private, that is going into this space in the US. We've got massive federal investments, more private investment than we've seen before. And we have to figure out how to turn that moment into actual change. So I would say now is the time for everybody that we've talked about during this podcast to get out there and try something. It might not work. That's okay. But it's really important that we figure out what is going to meet farmer needs in financing the transition and how those pieces of the puzzle can all fit together. So that's the fun I get to do every day, and, welcome more people to the party.
Amazing. Thanks so much for the work that you do.
Thank you, Patrick. This was fun.
Thanks for listening to this episode of The Business of Soil Health. Our goal is to explore how new financial tools may or may not support producers' stewardship of their soil. We love hearing from listeners, so don't hesitate to reach out with any suggestions or guests you'd like for us to feature. And don't forget to subscribe or leave a review on your favorite podcast platform.